Let me ask you a very simple question. When you open your trading platform, what is the exact first thing that crosses your mind? Let me guess. You look at a setup and you immediately think about how much money you are going to make. You are hunting for that magical 1 to 10 risk reward ratio that some guru in a rented mansion sold you. If that is your mindset, keep scrolling right now. I have absolutely nothing for you. You're not a trader. You are a gambler, and the institutions thank you for your daily donation. But if you are exhausted from being the exit liquidity for hedge funds, and you are finally ready to treat this like a mechanical system, listen very closely. Grab a pen, because the next few minutes will completely dismantle everything you thought you knew about risk management. Most retail traders fail because they lack a parametric risk model. They think risk management is just throwing a random stop loss above a candlestick and hoping for the best. That is not risk management. That is a trap. Real institutional execution requires a mathematical alignment between 3 variables: your available capital, your velocity, and your historical drawdown. Slowly. Let us start with variable number 1, your capital and cash flow. Stop lying to yourself about your financial reality. It is not just about the 500 euros you scraped together to fund a broker account today. The real question is, what is your monthly disposable income? If you blow those 500 euros, can you inject another 500 next month? Or are you going to be paralyzed by fear because that was your rent money? If you are trading with scared money, your System 1 emotional brain takes over. You will close winners too early and let losers run, destroying your mathematical edge. You need to know your exact monthly reinvestment capacity to structure a risk profile that lets you sleep at night. This brings us to variable number 2, velocity and the account type. Are you in a rush to quit your job, or are you building generational wealth? Let us say you have a personal account with 500 euros. If you deploy an aggressive risk model, risking 2% per trade, you are risking 10 euros. Even with an incredibly high win rate, you are not going to get rich this way. The math simply does not support it. So what do the smart operators do? They seek institutional leverage. They go after prop firms. But here is the massive illusion that destroys 95% of retail traders. They apply personal account risk models to funded accounts. If you take an aggressive 2% risk per trade on a $100,000 prop firm account, you feel like a genius when you win. But what happens when variance hits? And variance always hits. This is variable number 3, the drawdown. You need to know the historical drawdown of your strategy. Let us say your system has a 50% win rate. Statistically, a losing streak of 5 consecutive trades is not just possible, it is a mathematical inevitability. If you are risking 2% per trade on a prop firm and you hit that 5-trade losing streak, you are down 10%. Congratulations, you just breached the maximum drawdown limit. You just lost your funded account. You spent weeks passing the evaluation, only to be liquidated by the algorithm because you did not understand the math of losing streaks. When you operate large capital or prop firms, your risk must be conservative, 0.5% or even 0.25%. You prioritize survival over speed. This is exactly why, inside the Unfiltered Alpha protocol, we do not chase absurd 1 to 10 ratios. We operate on a strict 1 to 1 or maximum 1 to 2 asymmetric risk basis. Why? Because it drastically increases our strike rate and minimizes our time exposed to the market. We let the retail crowd fight over the crumbs of a massive trend, hoping to catch the absolute top or bottom. Meanwhile, we surgically extract our percentage in the safest, most liquid zones of the blueprint, and we leave. It is boring, it is highly mechanical, and it is exactly how real wealth is compounded. But here is the harsh reality. Right now, you are completely blind. You do not know your true win rate. You do not know your maximum historical drawdown. You are executing trades based on retail patterns that were designed to trap your liquidity. You can spend the next 4 years bleeding your capital to the market trying to figure out this infrastructure by trial and error. You can keep blowing prop firm evaluations because your risk parameters are flawed. Or you can bypass the pain. You can step into the shadows and acquire the exact architecture we use. For $27, you get the unfiltered alpha protocol. You are not buying a course, you are buying an institutional blueprint. You get the parametric calculators, the risk frameworks, and the exact mechanical rules we deploy daily. No fluff, no lifestyle nonsense, just the raw data you need to stop being a victim of the algorithm. It is your capital. Keep feeding the machine with your flawed math, or learn to read the code. The vault is open. Are you inside, or are you still trading blind?